here. Hopefully everybody, apologies for the any mix up on the logistics here with this. So I want to say thank you very much to the Dallas Entrepreneur Center for hosting us. Also, we are sponsored globally by American Express and Oracle. It's pretty cool. So thank you to those folks. And special thanks to Chris Douvos of Ahoy Capital. What we do in this, if it's your first time to Startup Grind, its mission is to educate, inspire, and connect entrepreneurs. And it's just a fireside chat. This is not a pitch on a business. It's designed to be interaction. So if you've got questions, put them in the chat. And the way that we're going to start out is I'm going to ask Chris the only question that I ask every single guest. Everything else is extemporaneous. And he's going to answer it 30 seconds, 3 minutes, however long it wants to last. You're going to learn a little bit more about him. And we've all heard of Steve Blank, customer-centered management, customer-centered development. And so then what we're going to do is we're going to go back to the audience and say, hey, you know now a little bit about Chris. What do you want to learn? What are some of the topics you want to cover? If you have a specific question, you can do that. If you just want to say, what about, venture rounds or raising capital or something like that, right? Something in general, do that. And then I'm going to weave that into the conversation. And it's not going to be like, I'm not going to say, oh, well, this is exactly the question right then and there. We're going to have a conversation about it. And then as naturally, we're going to go into the topics that people want to cover, because you're here to learn. Traditionally, obviously, we're in person, so you're here to network. That's kind of hard in this case. So we really want you to learn this time. And Chris has a really unique background. He was with Princeton Investments, so he helped work with the endowment there. Because I like to say the most client-friendly way of investing is a university endowment. You have unlimited horizon. You typically don't need access to all that capital, and you can pick pretty much any asset class you want. And as we all know, I think it's 94% of your returns are asset allocation based, and in your asset class. So we may talk about that a little bit. And then he was with Via Funds, which is a fund of funds. He's done some other pretty interesting things, and he's the founder of now called Ahoy Capital. And Ahoy's, it looks like it's a little bit unique model. I'm really interested in this. I know you do the venture capital fund of funds, but it looks like you all might do direct investing too, which I haven't seen a lot of funds do that. And I'm really interested in kind of your insights into how that works, because that's pretty cool. So, and then at the end, what we do in person, and we're going to try to figure this out online, is if anybody remembers the Gong Show, go look it up. Chris is old enough to remember the Gong Show. And what Startup Grind, a lot of the ethos is how can you help someone, and what kind of help do you need? And it's not like, oh, I'm an attorney and I, help people, incorporate their business. No, it's how can you really help an entrepreneur further their mission, or help them sell something or recruit somebody or do something. Or what are you looking for? Maybe you're looking for a co-founder. Maybe you're looking for, somebody that understands, conversion optimization. And so what we have done in the past, at the end of the Q&A, so we have the session, we have the Q&A. At the end, you just raise your hand, stand up, say, hey, this is my name, this is my business. And if you spend more than 15 seconds on it, then we're going to give you the gong, right? So no, this is not to be advertising your business, but it's something where it's literally really interesting. The statistical probability you meet the people at this event that are able to help you the most is inversely proportional to the size of the event. And usually we'll have anywhere between 50 and 150 people at these. And so, if you don't stand up, say, hey, I'm looking for somebody who has XYZ skills, then you're probably not going to meet that person if there are, 40, 50 people in the room. So that's what we do in person. And as I think through this in real time, virtually, what we'll do is just put that there along with your email in the chat. And what we'll do is we will send out, hiccups. We'll send out a message after this to say, hey, Jamal Martin is looking for XYZ, and here's his email address. And that way you all can connect offline and get a little more, it's obviously really difficult to network, in something like this, but that doesn't mean we can't kind of iterate and try something that's unique. And hey, if we fail, we fail, but at least we tried to help everybody that's on this. So without further ado, whatever ado means. So once again, welcome, Chris. So we call it Startup Grind, not Startup Joy, because it is just that. It can be a real grind at times. And so my only question is, what is your passion? What gets you a speeding ticket coming to work, even though today's ain't going to be really easy, which sometimes we know beforehand, sometimes we don't. But what really kind of gets you going in the morning to get to work where you can't wait to get there?
Well, I'll tell you what gets me a speeding ticket coming into work is usually because I'm late for a call because I've overslept because I'm
Yeah.
when I was a freshman at my high school, we didn't have grades. We had, comments. And I remember my English teacher for my 8 o'clock class wrote, Chris is cursed with a sleepy metabolism, and I fear for his future if he can't get it under control. But, um,
Is it kind of like
but
Walt
it's
Disney was told that he has no creativity, which is literally a true
exactly.
story? Yeah. Yeah.
Well, Fred Smith from FedEx, the idea for FedEx was his senior essay in the economics department in college, and he got a C on it.
Yeah. It will
So,
never work, I think is what the professor wrote on it. Yeah,
yeah. So here's to perseverance.
absolutely.
But I haven't actually persevered. I've just hacked my life. I'm in my office here, and my home is actually a good probably 8 iron away.
Like it.
So I can roll out of bed at home and be on a Zoom in the office in 45 seconds.
You're in Palo Alto,
But
right?
that's right, in Palo
Okay.
Alto.
Yeah.
Where you mentioned Steve Blank, I see him, all the time pre-COVID would see him all the time at the Creamery
Right.
here in town. So he's
I
he's
like
a good
Burma
cat.
Love too. Love that
Yeah,
place.
that place is
Good.
solid. What am I most passionate about? So it's interesting because just the quick version of this is, my parents came to this country from different places and met in New York. In fact, my dad saw these women sitting in Bryant Park on one of these unseasonable December days, and he saw these beautiful women, and it's 1970, and he bought an armful of hot dogs and walked over to them and said, "Ladies, would anybody care for a hot dog?" And he started chatting up, went on a date with my mom that night, and they were married 3 weeks later, and they just celebrated their 52nd wedding
Oh, that
anniversary.
is so freaking cool.
Isn't that
Congratulations.
wild? But the reason I bring that up is, my parents, were both, like I said, immigrants, and they came to the United States because they really believed that in the U.S. anything was possible. And so even though my dad was a cab driver and my mom was a maid, they really had this vision of America, and this was in the kind of in the tail end of the space race, and
Yeah.
and there's a lot going on, and we kind of had our heads filled in 1977 with Star Wars, and my cousin was a big Star Trek fan, and so it was and I had this vision of the future, and I didn't really understand, kind of nod at me, how do we make a better world. My dad always calls me a techno utopian, and
Better than techno dystopian.
that's well, they always say Los Angeles is a successful dystopia, and San Francisco is a failed utopia.
I love that.
But anyhow, yeah. But it wasn't until I got to high school and I was reading Walt Whitman, when he talks about California, and I believe, California is a metaphor for the United States. And he said, in California, I see the genius of the modern, the child of the real and the ideal. And I always that, that was really, it really struck me. He goes on to say, in California, I see populous cities and the latest inventions, with steamers on the river and many a thrifty farm with diggings of wool and wheat and the grape and yellow gold. And he talks about this stuff. And I was just like, wow, he's imagining the future, from 1850, populous cities and the latest inventions. Right. And, and there's this kind of, in that child of the real and the ideal, that he talks about, I kind of saw this future, and I didn't really know how to kind of capitalize on it until I got to Princeton and started doing venture capital. And I was like, whoa, this is my calling. And so a long answer to your question, but really, what gets me excited in the morning is working with funds and entrepreneurs to help them realize their vision of making the world a more friction-free place, so that
Right.
people can most fully, kind of achieve their potential.
Yeah, well, that's pretty cool. So as folks start to pull in, some of the topics they want to cover, what, so I sent a direct message. We're still learning this platform, folks. Hold on a second. Yeah, everyone. And then here, what topics do you want to cover? Just so y'all know, we had technical glitch beforehand, so we're doing some things here that we're just doing it on the fly, which is part of it. As they say, Saturday Night Live, it's live for a reason. So I think first thing I'd like to understand, you chose venture capital for a reason. I think part of it is inside of your answer that you had there, but why was it, and what was it that was really attractive to you around venture capital?
Well, I'm going to give an answer that's actually kind of unfulfilling. I joined Princeton's endowment in the summer of '01.
Mm-hmm.
And, this is, kind
That's
of
great
15,
timing.
I mean, 15 months after the tech wreck, right? Like,
Right.
so here I am, and
Right before 9/11.
right
And
before 9/11. And in fact, I was sitting in Newark Airport on 9/11, kind of getting ready to get on a plane to Seattle, actually, to meet with some ex-Microsoft guys that were starting a fund. And that was a crazy day. But anyhow, so within 3 weeks of my getting to Princeton, I was going to do real assets like, timber, oil, gas, real estate, all this stuff, solely because in my interview, somebody that I knew had told me that Princeton did a lot in timber, and timber is this amazing asset class because if the price for the commodity, it's like completely counter cyclical, because if the price for the commodity is low, you leave it in the ground and it continues to grow and actually becomes more valuable because the woods become kind of bigger, all that stuff. And so I did this whole talk during my interview about timber, and they thought I was some kind of like arborist or something. And so I was going to go do real assets, and then I get to Princeton, and the guy who did our venture stuff actually quit to go to another endowment. And they said, who wants to do venture? And it's like that line in the movie Stripes where they say who's wants to volunteer, and all the soldiers are in line, and everybody steps backwards, and Bill Murray's standing there. So that's how I became a venture guy. So like a happy accident. But then I had all the rhetoric prepackaged with the Walt Whitman stuff and other things. And then kind of the second thing that got me was, we were spending a lot of time in California, in Seattle, in Austin, and other places that are pretty nice to visit from the East Coast in February. So I was like, this venture thing, there's something to this. Walt Whitman calls California a sunny and magical land, and I really bought into that. So, but kidding aside, then you started talking, and this was, we were big investors in Sequoia, so we had a big Google position, in those days, and you started seeing like this kind of new world, coming. And there's this old line that that the internet was overhyped in the short term and underhyped in the long term. And I think we're starting to see that, right? The outcome of that, and you could really see it and feel it in kind of 2002, 2003, and I'm just like, holy smokes, this is amazing. And then all this stuff started to happen with like lean startup, and I had these hypotheses, and that sent me in certain directions. And then I started doing hardware stuff and robotics and autonomy and stuff like that. And I'm just like, wow, this is amazing stuff. Like in my next call after this, I have one of the direct investments we have is in a company called Robotics. You should check them out. And they basically do soft exoskeletons. So they do a lot of work with the Army and the kind of soldier of the future stuff. Kind of making soldiers, it's like the closest we have to like a lightweight Iron Man suit right now. But it's also great for like, medical rehab and stuff like that. And I'm like, wow, this is just cool stuff. I get to do cool stuff.
Yeah. No, it's a lot more interesting on a variety of different levels. It's kind of goes back to Warren Buffett versus Bill Gates, right? Bill Gates or Warren Buffett will say, I don't have the vision to see what the future is like, but I can see demographic trends and what people are going to use. Where Bill Gates, he's motivated by creating the future. And there's the two people in the world, and you can kind of break them out that way. So we're getting some good questions here. We're going to kind of weave in. What I do want to do is I want to start out, because having your experience in the university endowment, what a lot of people don't know is that's the source. That and family offices are of a lot of the venture capital money, probably an overwhelming percentage if you look at, family offices and endowments. And put your LP hat on. And for those who don't know, my name's Lee Blaylock. I've been in technology for a long time, worked for Dell and Oracle, started some companies. But one of the companies I started, the only company non-tech, is a company called Annandale Capital. And we're an investment advisory business. We manage about $800 million of assets. So we allocated to venture. And so I've kind of been on both sides of the table, and it's really fascinating to me about how little a lot of founders understand. I would call it the ecosystem, the value chain of where the capital comes from and what their motivations are, right? Because, as you well know, David Swenson in the book Pioneering Portfolio Management was really, he was instrumental in helping institutions understand that, you trade off liquidity for risk. And you can take a little bit riskier bets on a percentage of your portfolio, and you get outsized returns rather than just play in the public markets. And was that something that was motivating to you? And kind of talk about when you all were at Princeton, the dynamics of getting into venture. Like, what percentage of the endowment at Princeton was allocated to venture, and what were you looking for in a venture capital firm?
Yeah, so at Princeton, we had a 15% allocation to private investments, so that's buyouts and venture. And for us, it was split about 50-50. So about 7.5% of the endowment, which at the time was about $10 billion, was in venture. And so, we had a pretty, pretty sizable, one of the larger portfolios, out there. But it's amazing. One thing that I get the sense that entrepreneurs, don't fully understand is that sometimes is that every dollar has, demands a return. And so we often hear entrepreneurs, talk about vulture capitalists and this and that. But one thing that's, kind of interesting is, if you think about it from our standpoint at the endowment, or in my case at the, at the fund, and my investors are smaller university endowments that, people like Case Western and Carnegie Mellon, people that couldn't necessarily have a dedicated person, kind of on the ground. For them, investing in startups is, like buying the furthest out of the money, longest dated option, right? And so, so if you think about the return that they need on that capital, it's a pretty high hurdle, because not only are they, taking on an immense amount of risk, but also, a ton of illiquidity, and there has to be a, kind of a compensation for that. And so, one bit of advice I have, to entrepreneurs is, a lot of entrepreneurs, especially in this environment where capital, somebody once told me venture works really well when time is cheap and capital is expensive. And when capital becomes cheap and time gets expensive, look out. And that's the situation we're in now, certainly in the Bay Area, and from what I hear in another, bunch of other startup hubs. Time is really expensive. Things are moving fast, and the capital is really cheap, or it seems cheap. But the problem is that entrepreneurs don't always realize that that when they raise $1, that demands a return, and that return kind of eats into their own return. And so, one plea I always have, although sometimes it seems like, trying to, hold back the tide, with the sign, the plea I have is like, raise as little as you possibly can. Even if people are kind of throwing money at you, because, inevitably, even if you can manage the dilution by getting a higher valuation, but then taking a higher valuation means that you need a certain kind of exit. It takes you off a path for a more modest exit where you could be happy. And a lot of the grindy stuff that happens in startups happens because people have their companies miscapitalized. So one piece of advice I have, and this is something we always told people at Princeton, like, where you can, bootstrap your company, look for non-dilutive financing. The company I mentioned, Rome, has gotten a ton of, DARPA grants and NIH grants and stuff like that. Non-dilutive financing is like music to my ears, and should be, to any entrepreneurs. Right. But yeah,
Sanjeev Sidhu, one of the founders of I2, which at one point in time, he was pretty darn successful, multiple $1 billion. He said it's a lot easier to go close $250,000 of revenue from a customer than to raise $250,000 from investors.
That's right. Right. Yeah. So anyhow, so short story long, people need to think about the, in a sense, the value chain, the capital chain. So there's the company, and then there's, sometimes an intermediary like me, like a a venture capitalist. Then there's an intermediary. Then there's, kind of an ultimate funder, like the university, or the, or the family office, or a pension fund, or whatever. And sometimes you have a consultant mixed in there. And every one of them is telling the venture capitalist, you gotta make a big return on this, and that return comes out of your hide as an entrepreneur.
That's true. Is IRR or cash on cash more important?
The old line is people raise on IRR, but get paid on cash.
Right.
There's a place in Greenwich, Connecticut called Miller Motor Cars. And that's where all the hedge fund guys buy their, kind of Ferraris and Aston Martins and whatnot. And the old joke is Miller Motor Cars doesn't accept IRR as a form of payment.
That's awesome. Yes, as my dad told me, money talks and people whisper. Yeah, so it's
true.
cash on cash return. Totally. All right, so let's kind of move forward to a couple other things that I think are.
How's Felicia doing? That's about 3 weeks into it already.
I don't know.
You got
if you can help us with that. Okay, so we're going to talk about Ahoy and what you all do and everything else. But what I want to do is I want to kind of ease into that to start out the following is the only thing that a entrepreneur really controls is how they allocate their time. And a lot of them, in my experience, start chasing money before they really understand what's the, I call it the Bill Walsh theory of investments, the West Coast offense. What's my highest percentage chance of raising money, based on how I go allocate my asset or allocate my time. And so knowing what Chris, from both sides of the table, how would you start to approach the overall process of raising money, right? Okay, I've got an idea. I think it's venture fundable. I'm going to go after that. And then, okay, obviously I need to get introductions and, there's all kinds of things about the meeting. I don't want to talk about the meeting. I want to talk about before you said like, okay, how do I go allocate my time to go identify who are the highest potential candidates for me to spend the most time on that, are in the, interested in what I'm having to offer.
Yeah. As it goes without saying, the answer to 90% of the questions that have ever been asked is it depends.
Yes, absolutely.
Right.
Yep.
So, it depends on a lot of factors that, including where you are, right? Like, here in the Bay Area, there's an old joke if, in the healthcare industry, if healthcare, keeps going on the trends it's going on, we'll all be lying in hospital beds, treating the person next to us. Some days I feel like in the Bay Area, with all the people running funds and syndicates and rolling funds and this and that, if trends keep going, we're all going to be like standing around in a circle funding each other's companies.
Right.
But so, it really varies. But like you said, I think, Lee, that was a great line, money talks and people whisper. If you think about the earliest days of your startup, there are two pieces of advice that I give people is, one, you need to mine your, personal relationships, the friends and family, to get some capital in the door, because there are a lot of professional investors, quote unquote, professional investors who will say, if you can't get the people closest to you to invest, then it's not worth investing in. And then the other thing is, to use that money into, whatever, kind of faculties you have at your reserve to get as much progress as possible. I think a lot of people, without actually taking, outside kind of institutionalized money, a lot of people have kind of decided, and everybody reads, all the blog posts and this and that, and they think that the answer is, to come up with a cocktail napkin idea, to find some VC to fund it, to, hit this milestone, get some other VCs in the mix. And that's, that's this kind of highway to oblivion. And if I can do an unsolicited, kind of pitch for a good friend who had a great idea, which is actually he's kind of given up on. If any of you guys know Indie VC, INDIE.VC. Yeah. So my friend Bryce Roberts was doing stuff where basically he was like, look, there's this whole swath, there's this institutional venture capital works really well for a certain kind of company, but there's like actually this whole, it's like dark matter that's like 90% of the universe and people, right? Like the dark matter of, finances, all these companies that are out there that don't actually want to raise money or don't have the hockey stick, growth prospects, but maybe have really attractive growth prospects and can become very big, meaningful enterprises. And they're scattered all around the country. And the question is, can you find them and create a financing instrument that makes it worth their while and doesn't dilute the heck out of them, but still gets you the kind of return that you want. And so Bryce did a lot of stuff in that regard, kind of exploring that and kind of coming up with security to figure that stuff out. And so, that's what I tell people is, the more you can stay off the radar for longer, and the more you can actually build your business, and get more proof of concept, the effort is linear, but the payoff is exponential. And so, that's kind of that's the thing I got.
Yeah. So for those that are familiar with YC or not, go look it up. Y Combinator. They're looking for companies that are growing anywhere between 5 to 10% a week, right? So if you think you've got something that's venture fundable, you're competing against businesses, to Chris's point, that are focused on growth and they understand growth and they have it. And I would argue that venture today is obviously different than venture, X number of years ago. It's really more growth equity, because they're not taking the riskiest bets that they used to, unless you're a portfolio company CEO or chief engineer, whatever, where they know who you are, they know what you're capable of, they know your network, and they're willing to do that napkin deal. But that's pretty rare from my understanding. If you disagree, let me know.
Well, I think that's actually a great and really important point, because I think what we're seeing, venture capital is always a haves and have-nots market, right? And I think the thing that we're seeing, even more so, it's been actually accelerated during, COVID time, is people are putting a premium on, kind of known quantities, proven entrepreneurs, people who are quote unquote backable, which means they fit a certain mold and have typically run a company before. And especially for people with kind of new startups, in new geographies or new areas, it's really hard to kind of break into that circle. But at the end of the day, if you've got a business that's up and running, that's generating kind of economic value and has, line of sight to attractive unit economics at scale, the closer you can get to that unit economics at scale and the more proof of that you have, the easier that is to fund. The other thing I'll say, Lee, on that point is, I think we've all kind of bought into this, this kind of Silicon Valley driven monoculture of like, Mark Andreessen says, I need you to have a plan for, hiring your next 1,000 engineers when you come to me with your seed deal. And, and there's this, everybody now bows at the altar of power law, which is like, your best investment returns multiples of your fund and everything else can go rot. We've so leveraged ourselves. It's the venture capital industry now reminds me of the Yankees. I'm a big Yankee fan. Like you live by the long ball and you die by the long ball. There's no singles, doubles, stolen bases. It's just all dingers, right? And so I think
Ruth, that had like the most strikeouts, is the same time he had the most home runs,
right? So I think that's really important for people to understand, because I do meet a lot of people who come here, like, kind of washing up on our teeming shores here in Silicon Valley. And they're just like, all right, where do I find the venture capital? And I'm like, well, number one, it's going to be really tough. And number two, the further along you can get, without, especially if you're not in like an exponential, kind of crazy exponential, like Y Combinator, style, as you described, company, somebody that maybe has nice linear growth and can be a meaningful business nonetheless. Right. You just want to get as far as you can on your.
Okay, so last question on that, then we'll kind of move on to a different topic. So what are the 3 or 4 things that I should be asking myself before I start to raise capital, in terms of, A, am I venture backable? And B, how do I go identify the venture firm that's going to be the most compelling to me?
Yeah. So to be, quote unquote, venture backable, I think you need to have a vision of how, and even, obviously we've got kind of the crazy, kind of Silicon Valley expectations, but there's also, Steve Case and those guys doing the Rise of the Rest stuff. They're doing some good stuff. But what everybody wants is a vision of how your company can become, an industry leader.
Okay.
And if you just, because it seems like every market is turning into a winner take all market, right? And that's actually one thing that I think is really unhealthy, but that's a whole nother discussion.
Mhm.
So if you think your company has, an interesting niche, I always say, if you feel like you have the three keys, right? Number one, a large market. Number two, a great management team. And number three, some sort of meaningful barrier to entry. If you've got some combination of those three that leads you to think you can be a meaningful company, then maybe the play is to go become venture backable.
Yeah.
Then in terms of finding venture capitalists, it's become actually people are so transparent nowadays, right? Like the number of people that kind of post on social media, trying to generate deal flow, clanging the pot, speaking at conferences, doing virtual, you'll see a lot of people both kind of locally and kind of Silicon Valley types, who should be doing that kind of stuff, because everybody wants deal flow. Like you can never be, what do they say, rich enough, thin enough, or have enough deal flow.
Yeah.
Right. And so to the extent that, you're in a space that's well-defined, if you're doing, AI, you go talk to, Lux or Data Collective, it's easy to find these folks.
So basically you're saying just do your research. It's a lot easier today with social and websites and everything else to find out what's their sweet spot, because if you're not in their sweet spot, then you're going to have a hard time convincing them unless you've got some kind of incredible story.
Well, that's right. But then the challenge becomes like finding them is one thing. Then the second challenge is actually accessing them. And that's where it's important to get some kind of in. And typically, if you can kind of network your way to like one of their portfolio companies or an exited portfolio company, usually people are very, it's challenging to get, it's easy to get on their radar, but challenging to get, money from somebody, if you go in cold. But if you can go in kind of some, through the side door with a warm intro or something, it's easier said than done. And it's pretty conventional wisdom. But that's the dark side of having, people so out there and transparent. The dark side is that they're also just deluged. So you need to have some way to kind of defeat their filter.
Yeah. So two things to build on what Chris said. Portfolio company CEOs, especially ones that have had exits, like Chris mentioned, are really good ways to get in there. And it's super easy to find what their portfolio companies. You just go to the website and do that. And then in terms of unique value, first time I raised capital, it was funded by Austin Ventures, Silicon Valley Bank, and Fremont Ventures. And we got turned down by Scott Sandell at NEA. But he said something I thought was really, really interesting. He had just left Microsoft. He was the Windows product manager. He was an associate. He wasn't even a partner at the time. And he said, we're looking for business with an unfair competitive advantage. And I said, can I help me understand what you mean by that? Which I kind of thought, but he had a great answer. It's Microsoft DOS on 98% of all PCs that are out there. That is a unfair competitive advantage. I go, okay, I get it, right? And, you talk about these network businesses, a lot of businesses, take advantage of network effects. And if y'all don't know what that is, you need to understand. And there's a great VC firm in terms of content called NFX, and they've invested in 60 different marketplaces, and their content around network effects are really important. And a lot of these venture firms, they're looking for businesses that have network effects because there's no patents on business process patents. And so if you can build an unfair competitive advantage through network effects and more people to grow, then that's a competitively differentiated business. So that's something as you guys are thinking about it. So going back to your talk about the market and the team. So I'm gonna make a statement that my mentor, Vin Prothro, who's passed, but he was a venture capitalist and started a successful company called Dallas Semiconductor, took it public, sold it to Maxim. He said a venture investor is going to look at the market as 35%. He's going to look at the team as 30%, and he's going to look at the product as 15%, and the rest is where it is in your portfolio and valuation, everything else. He said because the market is the most difficult thing to change, but it's also what drives the most potential. The team is second hardest to change, and the product is relatively easy to change to those two. And a great team in a great market, they will figure out a great product and all those dynamics. Do you agree or disagree? Because I've heard, people agree, people disagree. And the other thing is it depends.
It depends. So there's different views on that. I think that, you look at probably the greatest venture investors of all time, Sequoia Capital, and they probably say it's, 80% market, and 5% team, and
Because they'll replace the team
in a heartbeat, right?
Yeah.
In an absolute heartbeat. And so, I think everybody's got their own view. I'll tell you my own view, and maybe it's because I tend to be more of a product guy. Is I'm like such a believer in barriers to entry, because I believe any large market attracts all kinds of competitors. And so you need to think about your company's kind of particular moat. And that's actually one of the things that I think has really changed, especially as capital has flooded in the last couple of years, is that now we see, what I call weaponized balance sheets, right?
Mm-hmm.
Where people, all of a sudden you get SoftBank in there and they throw $300 million at your company, and you're now, you go from being nothing to being the 800-pound gorilla.
Right.
And so, I think, you need, this is a non-consensus view. I'm like kind of so far off consensus on this. But I actually think that, from my perspective, number one is barriers to entry. Number, for your product or your company. Number two is great management, because they can figure it out. And then number three is market, because I do think there are riches in the niches, right? Like I think there's right. That's my own view. It's actually not a widely held view, because there are people who think it's impossible to build a really big company. But we actually just invested. I'm doing a lot of material science lately, and we just invested directly in a company that does novel polymers. It's a company out of Caltech that was actually funded by DARPA, because their polymer helps prevent explosions in Jeeps that have been hit by IEDs. As a fuel additive, but then they found out this stuff had amazing like friction reducing properties, and so now it's being tested as a drag reducing agent in in pipelines and stuff. And the company's called Fluid Efficiency. They do, they're a great company, but that's not a market that you'll ever see. That company will never get acquired for $1 billion. It just won't. Right. The market's, the market is just, it is what it is. But if you can,
but it's not going to raise 500 million either.
Boom, right? If you can capitalize that company, and especially get some of that non-dilutive financing, right? Like from from DARPA, National Institute of Standards, like a bunch of these people, that can be pretty amazing. And you can generate, kind of outsized returns there. And that's the thing that I think is a challenge, is like everybody's so focused now on these monstrous outcomes, because that's what makes makes the headlines. But I think, you can make a lot of money in modest exits. Maybe I'm just a value investor lost in the valley.
Right, GARP is a good place to be. So let me ask you a question, kind of going back to Sequoia and talk about consensus. Sequoia requires unanimity in their investment committee, where Greylock says that their greatest returns are ones that were highly contentious in investment committee. If I'm an entrepreneur and I'm pitching, is it important for me to understand that dynamic where I've got to have unanimity versus just a strong sponsor? And is it kind of like, no, you got to focus on other things, which obviously you do, but that was really not that important to understand?
Yeah. The short answer is that stuff is more than likely going to be completely opaque to you.
Yeah.
Right. Wherever you are. So wherever you're, what I'd recommend to people, and this is actually, I give people this advice a lot. I tell a lot of funds, but I think it applies to companies too. I always think that when you're out fundraising, you're not raising just for this round, but you're raising for fund N+1. Mm-hmm. And you're meeting the people who then, because the problem is, what's the old line? Marry in haste and repent at leisure, right? And so, you're meeting these people and there's this like hurly burly, and then the deal gets done. But there's some people who prefer to see, instead of getting a couple of snapshots, they prefer to see movies. And so as you get, as you make these contacts, make sure to keep, the folks who were interested in your company, but maybe, not quite, heavy breathing for it, but like very interested, because those guys might lead your next round. The number of times I see that, and the number, that's actually something that I think entrepreneurs generally do badly because they're so time constrained. And I respect that, but keeping in touch, and kind of pinging those potential investors, every 3-4 months, just to keep them updated on, the progress of the company can go an awful long way.
Yeah, so Mark Suster at Upfront, he has a well-known, you probably read this. He said, I invest in lines, not dots, right? The first time he meets you, you're a dot. And exactly to your point, don't look at it as, hey, this is a, one and done. Look at this as the start of building a line. And obviously the more attractive the optics of that line is, the more you're going to get their attention.
Yeah. And so I think that's a really important point. And then to answer the question, which I didn't answer, about the partnerships, a big thing that is tough for like entrepreneurs to kind of suss out, but is to understand, does that partner that you're working with, because they're going to be your sponsor, and, some venture firms work like tennis teams where everybody's got their own match. Others work like, basketball teams where they're all kind of pitching in and helping each other out and assisting. But if your partner doesn't, it's important to understand how much juice they have. Can they get things done in their partnership? And everybody's going to posture and kind of act like they're making it happen. But the number of deals I've seen scuttled because it's a more junior partner. It's somebody, sometimes you see people who are on losing streaks or whatever. And especially if you're choosing between a couple of firms and going to, to investment committee, if you can triangulate and try to figure out, whether that partner's on a roll, how are their companies doing, because that's how you build clout in a partnership is generating
cash on cash returns. Yeah, that's actually interesting, because it was the thing I had. It was along those lines, is that I get introduced to a partner, and either that partner sloughs me off to another partner or to a junior associate. How do I handle that? And what do you do to suss that out? Because you made an unbelievably valuable point I hope people really listen to. It's not just the firm, it's the partner in the firm, and can they get the deal done?
Yeah.
And people don't talk about that enough.
Yeah. Yeah. And so, look, the one thing that's hard, that I struggle with a lot, my dad always said, the cab driver always said, my son, America is a system. And if you're inside the system, the world is your oyster. Right. And he was kind of, right about that, because, so much of what happens in venture happens because of personal relationships and frictional interactions and what have you. And that's why, the barriers to entry are, and success are so high. But kind of to your point, ultimately what, the cacophony, right, like of engagement, is I think what can make the difference sometimes. And so if you get connected to a partner, and they shuffle you off to an associate, the beauty is that by the very fact that we're on this call and people are engaging with people, you're meeting people like, and people have backgrounds and
right.
Lee, you were at, you've got a history of places you've been. To the extent that you can network through your friends back to that firm and the partner at that firm, and just, pop in a good word. Hey, Lee, that Lee guy, we worked together at Oracle, and he was a killer, right? Like that kind of stuff, triggers that want, and that sense of scarcity and excitement that, that often becomes the needle moving,
Yeah, no, that's a good point. One thing that's always been interesting to me in private equity / venture capital, your returns are directly correlated to your ability to get the best entrepreneurs through your door, as opposed to a public equity investor where I can go invest in any of the 4,500 public companies that are out there. Do I have an information advantage? And so the ability to get to those firms, to get to the right people, and for those firms to go find the right entrepreneurs, drives huge returns. There's another kind of school of thought that's not polarizing, but there are two different schools of thought. Do you raise only when you need the money, or are you building relationships continually? Because people, there are pros and cons to both of those approaches. What's your particular thought?
Look, I think that you raise not only when you need the money, but like less often than you need the money, right? Like you want to raise as little as possible because you take the least dilution, right? But that kind of conflicts with what I'm about to say, which is, it's like every human in history has died of the same thing, actually. Like your blood stops flowing through your body. And a lot of things can cause that, but like there's a medical term like desanguination or something like that. Everybody's died of the same thing. For startups, it's the same thing. Like there can be a number of causes that eventually, that
stops the blood flowing,
wound you, right? Like lack of product market fit or poor execution or whatever. But at the end of the day, you're out of cash, right? Like the dream dies when you run out of cash. And so for that reason, I think it's important to stay in close touch. Again, back to your great point about lines, not points. You want to be continually engaging with investors, who on the drop of a hat, are going to get excited about ramping up their own process for investing in you. So when you're like 6 months from your cash out date, you can go to them and say, all right, we've been talking for a year, let's go.
That's helpful. So let's move to Ahoy. So you had this idea, Via Funds was a straight fund of funds, right? Didn't do any direct investing, or did it do direct investing?
No, we straight fund of funds.
Yeah. So talk about your process, because that's, what is it? Jeff Bezos talks about, two-way doors and one-way doors, right? And selling your company is a one-way door. Building a product is a two-way door. You can make kind of an argument that this is a two-way door, but it's also a one-way door, because when you're doing direct investing, you probably are on the board. It takes more time, things like that, as opposed to being in the fund of funds world. So kind of give us the framework of how you made the decision to do both, and kind of talk about the pros and cons.
Yeah. So what's funny is the reason I started doing direct investing was First Round offered me their pro rata in Uber in the round that got raised at $600 million. And I didn't.
I have another.
Yeah, well, but what's actually funny about it is, like, at the time I was like, ooh, 600, that's a pretty sporty valuation. So that was, maybe I'm not the best investor, but that said, we just couldn't do it because our documents prohibited us from doing it.
Right.
But I did know, and kind of understanding what they were developing into. I did understand. I didn't think it was going to be 100x from there like it turned out being.
Right.
But I thought it could be like a good 10x from there. I thought that could be a good $6 to $10 billion company. And so I was like, we should have the ability to do this kind of stuff. So we started doing it, and we started doing all kinds of stuff. And investing is a journey, right? Like you learn so much stuff. And your latest investment is just the accumulation of all the mistakes that you've made all along. And so what I started doing is I started finding that we were excited about doing, I talked about, barriers to entry. And then I started believing that, the barriers to entry were most profound in kind of harder tech, kind of what people call deep tech. Mm-hmm. And we started seeing some really, it's a place where the supply and demand of capital is a little bit out of whack. And so for me, what I love is I love stuff that's typically coming out of universities or other kinds of labs. Typically seed and Series A with, entrepreneurs who have a lot of experience in their space, who just see a way to do, what some incumbent is doing, but a lot better, faster, or cheaper.
Yeah.
And so, those are the kinds of things that kind of grab me. And then the important thing is the failure mode in the space, the waterfront that I cover, And it's everything from autonomy to AI. We just did a ground penetrating radar, for autonomous vehicles deal. I talked about the polymers. We did a robotic controller called Fort Robotics. The failure mode for me is that some of these things never make the leap from science fiction to science fact.
Yeah. Right.
And then once they make that leap, then can they make that leap to sustainable business? And so for me, there has to be a vision and a credible story for how you get from where you are to, kind of attractive, sustainable unit economics at scale that turn that into a, kind of a business that generates EBITDA.
Yeah.
That's
so if I'm an LP in Ahoy, am I in one fund, or do you have a fund that's a fund of funds and then you have a different one that has direct, or how's that work?
Yeah. So I've got a fund that's about, I've got a single fund, and it's about probably anywhere from 2/3 to 70% fund investments. That's like the ballast. And then the other, kind of 30 to 33% is, direct investments.
Right. And so if I'm an LP, I'm investing in one fund, and your docs say that you've got to have some kind of percentage of invested capital, I assume, right?
Yeah, that's right.
So how do you, it's kind of getting a little technical here, but for the directs, how do you allocate follow-ons? Because you don't really have that dynamic in the fund of funds.
That's right. So we end up reserving some capital for follow-ons. There's some cases, though, some of the companies that we get into, it's pretty clear from the beginning, that we're sneaking in and are just going to be like Zymergen that just went public. We did their Series B in 2017, and I basically knew that was a one and done kind of thing. Mm-hmm. So we didn't reserve anything, and we'll make a nice tidy profit on that. But I would have loved to kind of follow on and bet heavier.
Right.
Right. But we'll end up like right now this stuff's marked at about 8 times our money. But I'd rather have 4 times our money on much bigger dollars, right?
Yeah.
But exactly. I won't, but the flip side is, in about half the companies I think I'll be able to do, we tend to be small, like 1 to 3% investors in the companies. We're not like really leading deals yet.
Okay. Right. So you're not taking a board position.
Typically not. Typically I'll be like what's great is in this call I'm having at 5:30 Pacific, I'm not on the board, but I'm like kind of a sounding board, kind of outside the board. And that's a role I like to play.
And that can be a valuable role for the management team, because you're a good proxy for the board, but you're not, there's just different dynamics when you're dealing with
it's low risk.
Yeah.
Right.
And that's a really good point. It's a really good point. And so from standpoint of Ahoy, well, let me go back. One thing we talked about a while back, and I think this is important for entrepreneurs to understand and talk about these dynamics. If I'm pitching a fund, it's really important to understand where that fund is in their life cycle, or is it not? Because they may have other funds coming down and they're raising. Kind of depends on what's your timing of when you need your capital, because maybe they're going to have a new fund in 6 months, but you've got to have it inside 6 months or something like that. Is it that important to understand where they are where the venture fund is in the cycle of the fund that's actually going to make the investment? Or is it, as the Germans say, es ist mir egal, it really doesn't matter?
It's funny. I used to think it was really important to understand where that fund was, because, it's like, it's like when you get paid and you're living paycheck to paycheck, as a lot of us have. By the time you're getting paid on Friday, by the time it's Wednesday of that week, you're starting to think a little bit harder, about whether you want, X or Y or Z. And I do think that dynamic does get in place. Some people really think harder about their last few investments than they do about, their first few. And they do think it's like, now with college admissions, everybody's like kind of crafting their class with, they're doing their like big thing in early decision and then filling out the class. Oh, we need a cellist and we need a third baseman, and they're that kind of complicates things a little bit. The flip side, the reason I say my view on this has changed somewhat is, funds, both inside and outside Silicon Valley seem to be raising much faster, right? The
Yeah.
capital is flowing so
2 or
fast.
3 year cycles. Yeah.
2 or 3 year cycles, whereas when I started in this business, it was like 4 or 5 year cycles, right? And I think, when you're on kind of a 2-3 year cycle, it's a much different ball game. It's much more fluid, and it's,
Okay. That's a good point. That's a really good point. So cool. So we've got some questions here. Let's talk about SPACs. I mean, you talk about, nobody were really talking about it 3 years ago, 2 years ago, and now you can't, change your underwear without hearing about a SPAC. Fad, or what's your thought there?
Look, I think SPACs are here to stay, but I think they'll continue to evolve, right? Like, I think there's this mania for them. And I think, a lot of people piled into them, but like, what you need is you get a SPAC. And then when the SPAC actually finds a target, then you need to raise a PIPE and de-SPAC, right? And that's actually
Tell them what a PIPE is. Private investment.
So PIPE is a public private investment in public.
But what is it, so people understand what a PIPE is?
Yeah. So for instance, we have a company called Spire, which sends up these nanosats up into space. They track shipping traffic and all this stuff. And there was a SPAC, somebody raised a SPAC. And the SPAC then goes looking for an acquisition. It finds Spire, and now they need to find a sponsor that's going to put in a PIPE. So this is usually a private equity firm. So I think in the case of Spire, it's Blackstone. And they'll put in like $200 million as an equity infusion. And then, basically it all gets kind of, it all comes together, and the company, is now a publicly traded entity with that, that PIPE, whoever sponsored that PIPE is now a big investor. The people who set up the SPAC, basically get bought out, by the PIPE and the public market, but they stay on because they get, kind of 20% of the shares as their, kind of promote their concession.
Right.
Right. And so you've got a lot of like elements of the capital markets coming in. I think we saw a big SPAC boom in 2006 and 2007 in the buyout world. And then it came to an abrupt halt with the global financial crisis. I don't think that this SPAC renaissance will come to an abrupt halt, but I think it's going to slow down a little bit because the number of people that can actually can and want to do the pipes are, is pretty limited. But I do think that there is a hunger for companies to go public in the kind of old dynamic, the kind of like year 2000 dynamic, not the 2020 dynamic. And by that, I mean, less revenue, slightly further away from profitability. This feels a lot more like the old, kind of four horsemen, like, Hambrecht, Alex Brown, Montgomery and Robertson Stevens IPOs, then, the Goldman, kind of, you need $400 million and, you need to have 2 quarters of profitability. That bar is just too high.
Got it. So Andrew Chalk asked a good question. How useful was your CFA in startup land? And for those of y'all don't know, CFA is a certified financial analyst. It's a 3-year test. And at least when I was running Annandale, only 15% of the people that sit for level 1 pass level 3. I don't know if that's still the number, but pretty impressive you've done that. So has it been helpful in startup land? Yeah.
And by the way, that's my CFA charter on the wall. And I've got I got a couple of like college diplomas that I'm going to put up there too, because I was on a Zoom with somebody and they're like, "Are you in a doctor's office?" And so I'm gonna go all in on that. That's a whole move right there. So here's Douvos. That's right. So this is my view on the CFA. I feel about it exactly the same way as I do about getting my MBA. And in fact, the CFA is probably, elements of it are probably the core of the finance curriculum in business school. And the short answer is it's been super helpful in understanding the world, but it sometimes makes me too clever by half. Because I think too much about, kind of value and unit economics and, all the like finance stuff. Right. Whereas, really what you're doing in startup land is congealing a dream and seeing if that dream can turn into something. it's like with a CFA and an MBA, I sit around and can tell you, all the reasons why a rocket can't get, to escape velocity and out of the atmosphere, while Werner von Braun is over there, sending things up into
Right.
space.
Yeah, it reminds me, Eric Schmidt has spoken at Startup Grind a lot, and he talks about how, some of the great companies actually create their own market. So if you're doing some kind of market analysis, what's the market analysis of people that are going to have an air bed in their house and they're going to give somebody, a breakfast, not a very large market. Well, evidently, you evolve and you have a good team and, it becomes a pretty interesting market. Same like Uber, right? They kind of created a market by making it so easy to have a personal transportation network. So my assumption is that if you've got an MBA, you've got, the CFA, that may put some guardrails on you in terms of how you look at the possibilities of markets as opposed to the actual dynamics of markets. True or false?
It's really interesting because as you were saying that, I was thinking, my own motto, which I pilfered from an award they gave away at my high school. My own motto is, give me a robust nonconformist with the courage of his convictions. And everything I learned in business school, steers me away from robust nonconformists.
Yeah.
Right. And that goes back to my story about Uber. That $600 million round, I was like, this is stupid. But then when I take off my MBA CFA hat and put on my, Palo Alto hat, I'm like,
dude.
Uber to the moon, baby.
Yeah, exactly. Well, the other college motto, as you said, high school, college, is from Faber College at Animal House: knowledge is good. It's a great line. So Dale Shover has an interesting question. What are some of the most common unrealistic expectations that founders have, and how do those unrealistic expectations get resolved?
Again, it depends. One thing that I see time and time again is that founders think that, and I can say this in an almost blanket way, but I think the best founders are able to surmount this. They don't realize how long, kind of product development will take. They don't understand how long, kind of really establishing product market fit will take. They don't understand how long it takes, because everybody sees these things that feel like overnight successes and are snappy. But the reality is that it's, I think a lot of founders, especially first-time founders tend to think that things will be too easy. As second-time founders, sometimes get really cocky, and think, that's the thing I see time and time again. Everything just seems to take longer.
Right.
And so I think, just accept that, that things don't move as fast. On the financing side, I think a lot of people, think that, that money is easy to come by. And it seems that way sometimes, especially now. But I think that that you need to really invest in your network. I don't think founders invest in kind of networking and ongoing networking on the finance side as much as they should.
Yeah, kind of that line: invest in lines, not dots.
Yeah.
So here, another one that is from Gilberto Quinan.
And one more really quick thing. The number of investors, the number of founders I know that and it's easy to become monomaniacal about what you're doing, right? It's what you're doing. It's taking up all your mind share. But a lot of people, really fall in love with their product. And that's actually something I see a lot, where they fall in love with their product and they can't see, how somebody could not love their product, and they take that really personally.
To that point, one of the great pieces of advice I've heard is, don't fall in love with your product, fall in love with solving your customer's problem.
That's a great line. And look, ultimately, I'm investing, a mentor of mine once said, you can fall in love with companies, but don't fall in love with the pieces of paper that represent a fractional share of their residual net assets, right? Equity, kind of comes and goes. You can fall in love with a company, but you don't need to fall in love with its stock, and especially at certain prices.
Yeah, that's good. So Gilberto says, what top factors do investors appreciate in hardware/chip with long and gated development time to reach prototype? over software's kind of quick and iterative approach. I mean, obviously, a lot of investors, they've gone to pure software, and you were talking about how deep tech and especially bio is really, really hard to go find early capital because you can get such great returns with these, capital efficient deals.
Yeah. And, look, the thing that's actually made me, and I actually did a talk a long time ago, like 5 years ago, 6 years ago, to a constituency of this group called Incutel, which is the venture arm of the CIA. And I was basically researching, kind of how, we do so much development in the, in the private sector. And then you look at, China and how they're really focusing on the industries of the future. Yeah. And, I tried to compare that to, Japanese industrial policy in the 80s and stuff like that. And it is amazing how short-term our thinking has gotten in venture, which, as I said, should be the longest dated, furthest out of the money option. And one of the things that's made me really, really happy in the last few years is the emergence of, meaningfully sized firms that are focused on frontier tech. And whether that's, kind of more, capital intensive hardware, heavy stuff. So guys like, Lux and Data Collective and, Khosla does some of that stuff. And then, seeing the acknowledgement, I think, on the part of, kind of the government, and we see the chip shortage and the impact right. that's going to have. So I think, I'm much more optimistic about the future, than I am about, kind of the recent past in this regard. And so, anybody who's thinking about doing, kind of a chip startup, anything that's capital intensive, I think, have faith and try, again, focus on that non-dilutive financing, because there's a lot of it out there.
Yeah, it's good. And that kind of follow on to that question there in your answer, Greg Head's asking thoughts on investments in infrastructure technology like the Boring Company. Just kind of expand on what you were just talking about, where, if you're doing core tech, you're doing frontier tech, deep tech, you will find markets because there's always opportunity if the economic return's big enough.
Yeah, and I think that's right. The thing with infrastructures, there's a whole nother world that's a little bit outside my purview of these infrastructure funds. It really got kind of pioneered in Europe in the mid 2000s. But in Australia too, you got these Macquarie guys that do Macquarie Infrastructure Partners and a bunch of these guys that are funding private roads and, buying airports and some of them are doing, kind of basic infrastructure as well. I actually think, we're going to see an immense amount of interest in infrastructure. Obviously, we've got the infrastructure bill, that's kind of somewhere between the White House and Congress. I don't know exactly where, and we'll see how that plays out. But we need a massive reboot. And I think of things like the Boring Company, which, it's basically tech-enabled infrastructure. It's disruptive infrastructure. And I think that's actually really exciting. And I think that we'll see a lot of people looking to fund that kind of stuff, kind of as we see, massive dollars through in this direction.
So Joel R. Asks, what specific industries and sectors does the firm, I assume he's talking about Ojai Capital, what factors do you consider when making investments in these companies? And does the company invest in pre-seed or seed stage startups? And if so, what metrics are you looking for? We covered some of this there, but I want to honor his question.
Yeah. So, and just to recap, I think, for me, it comes to, kind of good sized market, strong management team, a strong experienced management team, and very importantly, kind of articulable, barriers to entry. And then an ability to show a vision for attractive unit economics at scale, right. Which, a lot of people, how are you going to ring the register? And so that's important for me. We do mostly seed an A, and most often in conjunction with the managers that we've backed. So, I pretend to be a smart guy. And I'm not a smart guy, but I play one on Zoom.
Don't sell yourself short, Judge. You're a tremendous slouch.
You're a tremendous slouch. But that said, what I love is when kind of a manager with conviction is excited about something, and often we're finding ourselves in the same place, as these folks given our pond. And so that's basically it. But unit economics, are vital for me. They're not as vital for some investors. You look at some of these. I'm still not entirely sure how Twitter makes money.
Well, kind of to that point, Peter Thiel has a great line. He said, we wanted flying cars and all we got was 140 characters. So yeah, no, I get it. Kind of a follow-up. Andrew Chalk asked, do you require 2+ founders in order to fund? Y Combinator has pretty strong convictions on this. Where are you on the continuum?
It's interesting. My own view is that it is it's very important that a founder, at the end of the day, they're the evangelist for the company. And so they not only need to be able to attract capital, customers, team members, et cetera. And so, what you find is that in great teams, you've got, kind of a balance. Every great team is a well-rounded whole made up of jagged pieces that fit together.
Right.
And so, we've seen this move towards these quote unquote heroic founders, which sometimes are toxic, but like Travis at Uber and right. others. But even in the early days, Travis had Garrett Camp and some of those guys around him. Zuck had had some people around him, but in the earliest days, I think you need at least that kind of intellectual peer, to have that the conversations that kind of help push your thinking forward.
Yeah.
It's
okay. No, that's fair. So I'm going to read the last one. I'm going to give people a chance to say, hey, this is what help I'm looking for. Here's my email address. Here's not. Maybe nobody's going to do it. Maybe a few people. We're going to try this out. This will be the first time we've done that, but we do that very successfully in person. And, obviously we're all looking forward to get back in person, but at the same time, virtual school, right? So, we can do this. You're in one state, I'm in another, and, we get to expand the footprint. So they're good and bad with everything. So this is Michael Chmielewski. Apologize for not pronouncing your name correctly. But if your startup is a tech company, say an app, and you've already developed your MVP into a product with a team of equity holding volunteers, imagine that. You have a user base. And does this make it look less appealing for investors because there's less to build? Basically, does being too far ahead and looking too good scare away early investment? This is a pretty easy one to answer, but I want to get your thoughts on it to answer his question.
Yeah, and this is, look, I remember when I was at Princeton, I covered Greylock, and Henry McCants, who had been around, since the 60s, pioneering venture capitalists, always said, look, in the old days, like only in the 90s, mid 90s did we start to see, these cocktail napkin ideas get funded. In the old days, everybody bootstrapped their company. So, whether, you had, people giving their time and, for equity or raising money from friends and family, and getting to a point. And the beauty is, you say because there's less to build. I actually think that means you're further along in the valuation continuum, right? You're closer to revenue. So I think we've all kind of bought this, Silicon Valley, mythology of, two engineers, a dog, and a cocktail napkin. But that was like the belief behind indie VC, and I think it's still like relevant and vital. Which is, some of these companies, look, Atlassian got to $100 million in revenue without ever taking $1, right? That was basically a bunch of equity holding volunteers. Yeah. And they turned it into a business. That's my view. I don't know. You have a different view, Lee?
No, my first startup, we had 9 people working for free. So 6 people working for free for 9 months. And one of the reasons we got funded, they said, it's unbelievable what you all been able to accomplish with almost no money. And so imagine, giving you money and then you don't have to worry about those things. You can go build something. And so I think that the more progress you can make, and it's about growth. There's lots on the internet that you can read about growth, but growth is what companies invest and especially venture investors. And I wish I had a little piece of draw my white ball, but imagine a bell curve, right? And the bottom of it is returning the cost of capital. There's an A series company, a B series company, a C, a D, and an E. A is where venture plays, right? Because they're not returning cost of capital, but the public markets like B. And the longer and the faster you can grow, then the more attractive you're going to be. And the C companies are companies that still have some growth with them. Maybe it's cyclical, but they're starting to return cash. And the D companies are companies that the growth is not there, but it still can be a reasonable business, returning capital. And then, E companies are the ones that, they're in real big trouble. And so my experience is, as fast as you can get from moving yourself to an A to a B level company, you're going to attract capital, and you're going to have more options of capital. Kind of to your point, non-dilutive. There's some firms that are out there. They'll give you, if you're a SaaS-based business, they'll give you debt capital on your royalties. They just want the royalties. So that's non-dilutive, and it can be expensive at one level, but it can be really cheap at another level. And I loved your answer. 90%. It depends. It depends on the dynamics of your business.
And look, at the end of the day, the last thing I'll say about that is people love scrappy entrepreneurs. Like, that's actually like
grit.
Scrappy. That's the best, the best thing ever.
So last thing is, if I'm interested in this world, what are some of the good sources of blogs, of really thoughtful leaders in the space that I could follow? I could go online right now to Twitter or to their newsletter and just do that. Because one of the things that we try to do is we try to get people, and we some of this was already kind of implicit into some of the conversations we've had, but something you can take back to your office tomorrow and go, hey, I learned this yesterday, and this is going to help me, operate at a higher level.
Oh, yikes. I've kind of not been paying as much attention to the talking heads because I found that there's not a lot of new insight. But I will say somebody who's continually putting out good content is First Round Review.
Yeah.
So First Round Capital has a lot of good stuff that's like really on point for entrepreneurs. Great stories from entrepreneurs, stuff like that.
I like what they do. They take high performing functions inside their portfolio companies, and they isolate that person, and they have that person kind of talk about their experience and other things, which I think is pretty cool.
Yep. I think that it's awesome. Those guys do a nice job. I think the Andreessen Horowitz guys are trying to get more into content. I think, a lot of stuff they say is kind of interesting.
Yeah.
So
Bill Gurley's pretty good when he was active, but he's not super active anymore.
Not super active anymore. Like that's the thing. I'm starting to feel like, this is no country for old men, and I'm past my sell by.
Two that I find really helpful is Fred Wilson, Union Square Ventures.
Yeah.
And Mark Sister at Upfront. I think they do a good job on content.
Yeah, I think Fred's amazing. I think Mark, you have to kind of take with a grain of salt sometimes, but Fred's amazing. It's
all good. Okay, so that is going to be a wrap, I believe. If you go to startupgrind.com/Dallas, you'll see that Craig Lewis, he's the founder of GigWise. Really cool story they've got there. And then we got a go today from Sharmistha Dubey. She is the CEO of Match.com. The former CEO, Mandy Ginsberg, is one of our guests, and Shar and I have known each other for 11 years, and she said, I'd love to do it. And so we're going to find that time in July. Don't have one booked yet for May, but we've got some others. So go on to startupgrind.com/Dallas and register, and you'll get on the list, and we'll have all the logistics kind of ironed out for the next one. And Chris, so the most important question is, where's your next round of golf?
I'm going to play 9 holes tomorrow afternoon at the Muni here in Palo Alto.
Awesome. Well, good luck to you. Hey, thank you, everybody. Thank you very much, Chris. Thanks to the deck and to Google for Entrepreneurs and American Express. You guys make this happen. We're really appreciative of it.
Awesome. Thank you, guys.
See y'all.